October 24th, 1929, Black Thursday. In 6 hours, Americans lost $14 billion, more than the entire Canadian GDP was worth. 13 million shares were liquidated in a mass sell-off. Phone lines couldn't handle the trading volume. Communication with the stock exchange was severed. But few people know that this market collapse began with the decision of just one man. A man whom newspapers called Sunshine Charlie, America's most influential investment banker. This was Charles Mitchell. He was the one who triggered what we now call the Great Depression. 7 months earlier, Charles Mitchell uttered a phrase that was supposed to provide market liquidity. Instead, it set in motion the mechanism of the most catastrophic asset deflation in human history. The Great Depression lasted 10 years and destroyed the balance sheets of an entire generation of Americans. 25 million people lost their income streams, every fourth person. 5,000 banks became insolvent, wiping out the capital reserves of millions of families. 2 million Americans were left with negative net worth. Families lived in cardboard boxes in tent cities, bitterly called Hoovervilles. Suicides increased by 30%. In a country that just yesterday posted record equity valuations, people stood in lines for free bread. But how did it all begin? In the 1920s, America was experiencing an unprecedented bull market. The Roaring Twenties, Ford manufacturing output, consumer credit expansion, jazz clubs, rising commercial real estate. It seemed that compound growth would last forever. And it was then that a man stepped onto the trading floor who would turn the dream of wealth into a nightmare for millions. Charles Edwin Mitchell was born in 1877 to a working-class family in Massachusetts. Nothing predicted that this farmer's son would become America's most systemically important banker and alter the fiscal trajectory of an entire nation. In 1919, Mitchell became CEO of National City Bank, the country's largest financial institution, with assets of $2.7 billion. This exceeded the sovereign budgets of most countries in the world at that time. But the ambitious banker had a disruptive thesis that would change everything. Before Mitchell, equities were rich men's instruments. Only 500,000 Americans, less than 1% of the population, held stock positions. Ordinary people parked money in savings accounts or purchased government bonds. The capital markets were a closed club for institutional players. But Mitchell identified massive untapped market potential in this gap. Every American should have equity exposure, he said. Why should portfolio returns belong only to the wealthy? In 1920, Mitchell incorporated a subsidiary, National City Company. Its mandate was simple: distribute equities to retail investors directly through bank branches. When a client came to open a savings account, they were offered allocation into the American growth story. Mitchell turned securities distribution into a science. He studied every variable: behavioral economics, investor psychology, the financial aspirations of working-class Americans. His sales force was deployed across 69 branch locations nationwide. These weren't conservative deposit takers. They were trained capital market intermediaries, following Mitchell's proprietary sales methodology. The marketing was revolutionary for its time. Advertisements ran in newspapers. Compound your wealth by allocating just $15 monthly. Become a shareholder of American Telephone and Telegraph. Your portfolio will outperform inflation. You're an investor. Financial publications ran case studies. How a secretary from Ohio generated alpha in 2 years. A streetcar driver purchased his own home with dividend income. Brokers deployed sophisticated closing techniques. They told clients, "Mr. Johnson, you don't want to trade your labor for wages your whole life, do you? General Electric Equity. This is your chance to own a productive asset." Or, "Mrs. Smith, your husband works for Ford. Why not become a beneficial owner of the company?" National City Company offices were decorated with aspirational posters showing families enjoying the returns of equity ownership. Dividend income funded our dream home. Positive returns, capital appreciation, financial independence. Everything communicated. This is your path to wealth creation. But the real innovation was in the leverage mechanism. Equities could be purchased on margin. Deploy only 10% in initial capital. Borrow the remaining 90% from the brokerage. Imagine you have $100 in investable capital. You control $1,000 in equity exposure. If prices appreciate 20%, your return is $200. A 200% return on deployed capital. Sales representatives demonstrated this with straightforward scenarios. Look, Mr. Brown purchased Radio Corporation shares for $500, committing only $50 of his own capital. In 6 months, they appreciated $150. His ROI was 300%. Your savings account would have yielded only $15. The result exceeded all financial projections. From 1925 to 1929, margin loan balances grew from $2 to $8.5 billion, a 425% increase in 4 years. Retail equity participation grew from 500,000 to 10 million investors. A teacher from Ohio mortgaged her home to fund a Radio Corporation position. A farmer from Kansas liquidated his livestock to acquire General Motors shares. A mechanic from Detroit committed 6 months of gross income to Ford stock. Everyone believed this represented their path to financial independence, and Mitchell collected the management fees. He was called a financial visionary and the democratizer of capital markets. In 1928, his total compensation reached $1.2 million, equivalent to $20 million in today's purchasing power. Business publications profiled him as the man who gave every American access to equity markets. But Mitchell continued innovating. He structured investment trusts, leveraged vehicles that purchased equities with borrowed capital. These trusts themselves became publicly traded companies whose shares were again purchased on margin. The result was a multi-layered debt pyramid constructed on the assumption that valuations would appreciate indefinitely. By spring 1929, even the most bullish economists began expressing concern. Price-to-earnings multiples were expanding faster than underlying economic fundamentals. The Federal Reserve issued a hawkish signal. The market was exhibiting speculative excess. The data was alarming. Blue-chip equities were trading at price-to-earnings ratios of 15 times annual profits. For reference, such valuation multiples today would indicate a speculative bubble requiring mean reversion. On February 6, 1929, the Federal Reserve issued a tightening directive to member banks. Restrict issuance of margin loans for speculative equity positions. The central bank demanded reduced leverage ratios. The market's reaction was immediate. In March, valuations began correcting. Within days, Americans faced billions in mark-to-market losses. Panic was spreading through the trading floors. The bubble appeared to have begun deleveraging. And then, on March 12, 1929, Charles Mitchell made the monetary policy decision that altered financial history. He convened a press conference and delivered remarks that would become infamous. National City Bank will inject whatever liquidity the market requires. We will not permit an unnecessary credit contraction to occur. The effect was instantaneous. Headlines ran, "Sunshine Charlie backstops the market." Equities rebounded. Within 1 week, valuations recovered all losses and established new all-time highs. After Mitchell's intervention, the market entered its terminal phase of speculative mania. In summer 1929, equity prices reached historic peaks. The Dow Jones Industrial Average surged to 381 points, a valuation ceiling that wouldn't be breached for another 25 years. 3 million new retail investors entered the market in the final months before the correction. Households secretly liquidated jewelry to fund equity allocations. Shoe shiners were providing stock tips. Even children deployed pocket money into securities. Those who had entered earlier felt like skilled capital allocators. Junior clerks had become paper millionaires. Chauffeurs were purchasing real estate. Secretaries were acquiring luxury goods. America was intoxicated with the illusion of perpetual capital appreciation. But beneath the facade of prosperity lurked the mathematics of systemic collapse. Every dollar allocated to equities was collateralized by only 10 cents of actual capital. A 10% price correction would wipe out the margin investor's entire equity position. A 50% drawdown would leave them with debt exceeding an entire year's gross income. By autumn 1929, institutional money began de-risking. Large, sophisticated investors, pension funds, insurance companies, and proprietary trading desks identified warning signals invisible to retail participants. First, macroeconomic indicators were deteriorating. Industrial production contracted, auto sales declined, housing starts decreased, yet equities continued appreciating, completely decoupled from fundamental value. The divergence between equity valuations and underlying economic output had become unsustainable. Second, institutional investors understood the mechanics of margin leverage better than retail participants. When 90% of market capital represented borrowed funds, any price decline would trigger a self-reinforcing liquidation cascade. Joseph Kennedy, patriarch of the future president's family, later observed, "When my shoe shiner started offering stock tips, I recognized the signal to reduce exposure." Third, insiders possessed intelligence about Federal Reserve tightening plans. The central bank was preparing rate hikes, which would increase the cost of margin financing and trigger mass forced liquidations. Institutional players began systematically taking profits. They distributed holdings in measured tranches to avoid front-running the correction. But by October, the selling pressure overwhelmed market absorption capacity. Certain banks received intelligence that the Bank of England planned to raise its benchmark rate, which would mechanically force the Fed to follow with its own tightening cycle. On the morning of October 24, 1929, New York's largest investment houses made a coordinated portfolio decision. Exit risk assets immediately. They initiated large block sales, hundreds of thousands of shares simultaneously. Prices began declining. Initially gradually, then in a cascading sell-off. By noon, forced liquidations accelerated. In a single session, 13 million shares changed hands, 5 times average daily volume. Brokers couldn't process order flow. The telecommunications infrastructure collapsed under transaction volume. The systemic contagion that Mitchell had inadvertently engineered through his leverage architecture was now self-executing. First domino. Declining valuations triggered margin calls from prime brokers demanding additional collateral. Second domino, investors lacked capital to meet margin requirements. Forced liquidations ensued, further depressing prices. Third domino, declining collateral values rendered leveraged positions ineligible for refinancing. Banks suspended new credit facilities, removing market liquidity entirely. Fourth domino, banks with excessive margin loan exposure became technically insolvent. The first institutions to fail were those that had replicated Mitchell's leverage model. October 29th, Black Tuesday, total market failure. In a single trading session, Americans suffered $14 billion in capital destruction, exceeding total U.S. expenditure in World War I. Behind the financial statements lay human catastrophe. Edward Hopkins, a mechanic from Detroit, had established a $5,000 long position in Ford equities, representing his entire liquid net worth. By November, the position had an unrealized value of $200, and his prime broker issued a $3,000 margin call. Hopkins hanged himself in his garage. Mary Kayfield, a teacher from Ohio, had leveraged her parents' property as collateral to fund a radio corporation position. After the crash, the bank foreclosed on the real estate. 3 generations of family lost their primary asset. In New York, crowds gathered not only outside bank branches seeking deposit withdrawals, but also on bridge infrastructure. Suicide rates reached historic levels. The Brooklyn Bridge became a monument to financial despair. Those who yesterday carried 7-figure paper wealth terminated their lives there. What about Mitchell? In 1933, he was subpoenaed before a congressional hearing. Senator Carter Glass asked, "Do you acknowledge personal liability for the financial ruin of millions of American families?" Mitchell replied, "I sought to provide retail investors access to equity markets. No one was coerced into purchasing securities." But regulatory accountability eventually found Sunshine Charlie. In 1933, he was prosecuted for $850,000 in tax evasion. He was forced to resign in complete disgrace. The man celebrated as the market's backstop became a symbol of systemic greed and regulatory arbitrage. American financial opinion was divided in its assessment of Mitchell. The financial press rendered competing verdicts. The New York Times labeled him the architect of financial catastrophe and the man who converted the American dream into balance sheet destruction. Retail investors held him in contempt. On the streets of New York, he was publicly confronted. One Detroit publication wrote, "Charles Mitchell extracted more wealth from ordinary Americans than any bank robbery in history. A robber steals a bag of cash, but Mitchell confiscated the retirement security of an entire generation." But institutional defenders also emerged. Many financiers argued Mitchell had not mandated anyone to take leveraged equity positions. Investors themselves had prioritized return-seeking over risk management. His former colleagues maintained that Mitchell had simply found himself at a systemic inflection point. Any banker operating within the same incentive structure would have made identical capital allocation decisions. As for National City Bank, paradoxically, the institution not only survived the credit crisis, but emerged with stronger market positioning. Following Mitchell's exit, new management terminated all high-risk structured products, refocusing on traditional deposit-taking and commercial lending. The bank received government backstop support as a systemically important financial institution. Moreover, the insolvency of competitors allowed National City to acquire their assets at distressed valuations. By 1935, the bank controlled a larger market share than pre-crisis levels. Mitchell spent the remainder of his life in relative obscurity. Post-prosecution, he relocated to Europe, where he consulted for regional financial institutions. Returning to the US in the 1940s, he established a modest private investment advisory. Sunshine Charlie became an aging financier remembered solely as the personification of 1920s speculative excess. Mitchell died in 1955 at 78, never publicly acknowledging his contribution to systemic financial collapse. The crisis he catalyzed permanently restructured American financial regulation. In 1933, Congress enacted the Glass-Steagall Act, mandating structural separation between commercial banking and investment banking. The legislative intent was straightforward: never again permit deposit-taking institutions to speculate with depositor capital. The Securities and Exchange Commission was established as a market oversight authority. Federal Deposit Insurance Corporation coverage was introduced. Strict margin requirements governing leverage ratios were codified into regulation. America legislated against repeating the same systemic failure. But the regulatory response extended further. In April 1933, President Roosevelt issued an executive order that fundamentally restructured American monetary architecture. Private gold ownership was prohibited. All Americans were required to tender physical gold and bullion to the Treasury at a fixed exchange rate. This represented a desperate attempt to reassert monetary sovereignty. As long as citizens could demand gold redemption for fiat currency, the government lacked the monetary policy tools to combat deflationary pressure. The gold repatriation program enabled expansion of the money supply and arrested the deflationary spiral, but at the cost of violating Americans' fundamental property rights over hard assets. Within a month, Americans surrendered more than 3,600 metric tons of gold, exceeding the current combined reserves of Russia and China. 1 year later, the Treasury repriced gold from $20 to $35 per troy ounce, generating substantial mark-to-market gains on the confiscated reserves. The structural damage of the Great Depression persisted across generations. The American economy required a full decade to restore pre-crash output levels. Millions permanently exited equity markets. An entire generation preferred holding cash under their mattress over maintaining brokerage accounts. Today, nearly a century later, the same financial architecture is reconstructing itself with alarming precision. 50 million Americans execute equity trades through mobile applications. Total margin loan balances have reached a record $900 billion. Platforms like Robinhood replicate Mitchell's original value proposition: democratize capital markets for retail investors. Zero commission trading, algorithmic execution. Deploy your paycheck into the market. A new generation allocates capital into cryptocurrencies and meme stocks, employing margin accounts and leveraged products. Identical promises of accessible alpha generation. Identical cheap financing rates. The same leverage mechanism Mitchell engineered nearly a century ago. The average American today carries debt exceeding annual gross income. Margin utilization has returned to 1929 levels, and once again, millions of retail participants believe current market conditions represent a structurally different paradigm. Charles Mitchell's story is a case study in how democratizing capital access without appropriate risk disclosure can trigger systemic failure. He genuinely sought to provide retail investors with equity market participation, but his leverage architecture converted the American dream into financial ruin for a quarter of the nation's population. Every American should have equity exposure, Mitchell declared in 1928. Everyone should be invested, the fintech platforms announced today. History doesn't repeat, but its financial cycles rhyme with precision. The next time you encounter promises of frictionless alpha and calls to democratize investment access, recall Sunshine Charlie and analyze the underlying revenue model. Ask yourself, who actually captures the spread? Subscribe for more insights into the history of finance.